Good afternoon, everybody. Welcome to today's live event. My name is Andrew Wilkinson. I'm delighted to be here with Dan Sheridan from Sheridan Options Mentoring, and today's subject is iron condors. Dan talked about this in last month's webinars, which is available from IBKR Webinars. Have a look at our campus site and look at all Dan's excellent recordings with us. Dan, welcome. How are you?
Good to be here, good to be with everybody again. I know we touched on the last webinar, touched on iron condors, and I said I'd come back and talk a little more detail of this trade that's been around a long time. And it's a good strategy for potential people who are looking for potential weekly or monthly income, and it's an interesting strategy. So we'll look under the hood of the car today a little bit on this one.
Very good. Okay, I'm going to put up the IBKR disclosures. IB Compliance always asks me to display the slide because we're talking about risky products, and please do take a moment to review. Dan is available for questions throughout the session. I've made him an organizer so he can see any inbound questions, and he does ask a lot of questions, and he will make you answer the question. So please locate the chat panel in the GoToWebinar software and do reply to his often yes or no questions. And I think that way we all get more out of the session. There's a good number of attendees here today. You will all receive a copy of a link to the recording when it's available in a couple of hours after Dan's wrapped up today at about 1 o'clock Eastern time. If you do want to get a copy of the handouts, it will be available where the recording link is, but it'll also be available in the handout section of the GoToWebinar panel here while the session is live. So you can expand that, click the PDF link and save to your desktop or wherever you want to save it. And with that, Dan, I'm going to put up your opening slide, and I'm going to go on mute and sit back and enjoy myself.
Well, welcome everybody, and glad to be here again today. And as we kind of, as I said, look under the hood of the car on the strategy called iron condors, and it's been around a while. I'm not sure how they came up with the name iron condors. The only thing with iron I think of, I'm a little bit older, showing my age, there was a rock group, Iron Maiden, in the 70s. Not that I was an Iron Maiden fan, but I'm just thinking Iron Maiden, I don't know what else they throw at the iron condor. But so let's delve in, Andrew. Let's get things rolling here. And let me start out, folks, by asking how many of you would admit in public that you have done a live iron condor in your life? Yes or no? So I get a little feel. How many of you watching this would say, Dan, yes, I've done one of these things called an iron condor, or no, I have not, right? Especially the ones that, you know, maybe you haven't done one, and that's fine, right? It's okay, and I think it's good. So if I say your name correct, please forgive me if I don't. Balupali, but I think that's a wonderful idea. When you're learning a new strategy, do it in a demo account or paper trading to get a feel of how it operates. But so what is this iron condor? And then I've got a few examples, and Wayne is bringing me up to something I'm going to talk about in a second. Kind of how people are doing them, or a new way that people are doing these iron condors over the last year and a half than maybe I was doing them 15, 20 years ago. So, you know, I'll address a little bit today the traditional way of using an iron condor, and I would call it a new and improved way. That's not the word. A different way of doing an iron condor in today's environment. Doesn't mean it's better or worse, and I will discuss that. So iron condor, first of all, what is this trade? And again, we'll maybe Andrew, what we could do real quick is, so we could start out with a picture and then we'll come back to some of this stuff. So why don't we start with here, and then I'll kind of go backwards, because it's if you're like me, folks, I like pictures. I'm a visual learner. And so here's an example of a 0-day iron. I'll tell you what, before we get into this, let's go to the next one, Andrew. Yeah. So folks, I would call this more of a traditional iron condor. Traditional iron condor would be, somebody might put it on 30 to 40 days from expiration. This is 27 days from expiration. And as you before we get into the giggly gook here, let's look at if you just look at this green graph, let's just focus for a second, on the graph. And so this is a trade that I'm putting, so I'm not going to get into what I'm selling and buying for this second. I'm just going to focus on the graph, right? And when you look at the graph, you have this green graph. I would call that the expiration graph. And so there's also a graph the day you put it on, but I didn't want to complicate the picture here. So when I put this trade on, I had 27 days to go. So you can see in the red there, I put this trade on an SPX at 51.25. And when I put it on at 51.25, you can just see from the green graph, because that's the profit. And then if you take your eyes and look a little bit to the left under that vertical P&L line, you could see somehow if we're between 49.70 and 53.20, we make some money, right? So that's, I put it on when we were at 51.25, and we've got 55 points below. I sold a put, and 50, what is that? 52.25, 50, we're in 56. Oh, I'm sorry. So 49.70, that's 100 and, what is that, 55 points, Andrew? So if at 51.25, I sold the 49.70 puts, that's 155 points if I did my math right. I sold a put out of the money. And on the upside, 195 points away from where trading, I sold the 53.20s. So that's called a short what? What would you call just that piece? The foundation of an iron condor is what? What? I gave you 50% of it, right? It's a short what? And we'll get to zero. It's a short strangle. So this is the piece I want to do of this. I'm selling an way out of the 27 days from expiration. I'm selling a put 155 points out of the money. And on the upside, I'm selling the 53.20 calls 195 points out of the money. So you could say, what's the reason for, you know what? Somebody said, I think Roger said, is there supposed to be a chat window? You know what I'm looking at, Roger, is I have a questions box here. So if you just type it in under questions, when I ask a question, or if you'd like to say something, you could just type it in there and I'll see it. So under the questions tab, at least that's what I'm looking at. So, okay, good, you saw that. So the bottom line is this. I would call this a high probability trade, that I'm saying, if in the simplest form, if SPX is between 49.70 and 53.20 in 27 days from when I put this on, right? I collect the entire credit of this, right? But because if you go to your, if you were to put in just to sell one put and one call at Interactive Brokers, your risk and your margin would be huge, right? Right? Ray says, can you move it along? Yeah, Ray, you know what? I'm like in the kitchen, and we've got some beginner cooks, we've got some advanced cooks, right? The advanced cooks are saying, Dan, get to the meat. The beginner cooks are saying, don't go too fast. I'm just trying to, the first few minutes here, Ray, just so you know, trying to keep, trying to go at a pace, make sure I don't lose too many people. Yeah, you can't, what do they say? You can't please everybody, but I will make sure there's meat for the advanced and the beginners. I don't lose the first 5 minutes, right? But thank you for it's good keeping me going here. So the easy queasy is, this is a high probability trade. I use this for weekly income, monthly income, and I'll get to in a second for daily income. But at a brokerage firm, at Interactive Brokers, if I just sold a naked put in SPX and a naked call, they're going to want my house, my wife, and my 3 dogs for margin, right? That's a joke. But the point is, and you say, well, Dan, if I'm in a portfolio margin account, which is a different type account, can I sell nakeds? And I said, I generally wouldn't do naked options, because I think the biggest problem in most, like a retirement account or whatever, A, they might not let you do it, but B, it kills your yield, right? If you have to put up exorbitant amount of money. So if you look at the longs here, I sold the 49.70 put in. Andrew, if you have the what do you call it? The bouncing red ball. I'm selling the put and call, but I'm buying my wings 10 points away. So on the call side, I'm selling the 53.10 call. Andrew, you there? I hate to bother you.
I'm here.
Yeah, do you got that red dancing ball or dancing circle?
Yep, let me just.
If you could show them that, this would be, a lot of people do, if you're a beginning trader, your longs would be 5 points away from your shorts. If you're, you get more comfortable with these, your longs could be 10 points away. If you get more advanced and you want to use more capital, 20 points away. Right now, if you look at my long options, 53.20 up there, that's 10 points out of the money from my short. And on the put side, 49.60 put 10 points away. So on this transaction, I brought in a credit of $2.30. Your risk on this type of trade, you just look at the width. The width of my call and puts credit spreads. This is an out of the money call credit spread, out of the money put credit spread. So I want to be hedged. My risk is $1,000. The width is $10,000, less the credit of $230 is $770. So my maximum risk here, if SPX went to 0 or a trillion, is my margin or risk of $770. I'm bringing in a credit of $230. This is just one contract. So your potential yield, the most you could make, would be 29% in 27 days. Now, I don't manage it and just leave it alone. So that's the gist of it. So the game, does everybody see from a visual, is unlike a speculative trader where you want the market to move, I'm saying SPX, you're at 51.25, stay between 49.70 and 53.20. Does everybody get that? That this is a range bound trade, right? Does everybody get that? So the most you can make is your credit. That's the most I could make. Now I'm going to talk to you how I manage these things, give you kind of an idea how I manage these things. But that's the gist. If you're a directional trader, take your directional hat off, put on a hat that says range bound. It's a different mentality, right? You could still do directional trades. You could still do covered rights, and I'll call those longer term trades. But this is your other piece of your portfolio, more range bound, right? You get a little bit of two-way action in the market. So on this trade, this is an iron condor. Now, this is a 27-day. This would be more of a traditional iron condor. And let me just give you on this picture just a little bit of information, and you could just enough to get you dangerous, and you can paper trade it. I can give you some principles on how I trade this. But somebody made a good point. I think it was Ilan. I said it. How many caught that the risk reward on this isn't so good? So I'm risking the margin. So I'm bringing in a credit of 230 to risk 770. Is that a good risk reward? Is that a good risk reward? Yeah, I'm going to get to short-term iron condor in a second. I knew everybody, yeah, it's like having someone speaking on classical music, or having somebody, if we had a classical musician on or a pop star, they'd say, would you hurry up with the classical musician and get rid of them and bring on the pop star? So I'm going to get to a 0-day iron condor in a second. Hold your horses. But the probabilities are very good. Just understand something, right? You ready? I'm going to tell you something most of you know, right? You can't have your cake and eat it too. If you're going to have a high probability trade like this, right? And I'll explain why it's high probability in a second. You're going to have a stinkier or not as good risk reward, right? If you want an iron condor where I'm bringing in $3 to risk $3, your probabilities go way down. So it doesn't make it a bad trade that a risk reward isn't as good as you would like it. What makes a bad trade is the person at the control center, the person at the steering wheel, right? So, and it's all, and the other thing is this, depending on your schedule, depending on your lifestyle, depending what you want, like Pablo said, too much risk. It's only too much risk if you have a management plan. If you don't have a management plan, for example, let me just give you, I'll give you a Mr. T starter kit risk management plan. You with me? That would work over time and give you something to paper trade. All right. I'll give you you ready for a risk, for a plan for an iron condor? You ready for a 27-day, just so we can get to the 0-day? Somebody say, yes, I'm ready. Okay. So I'm going to talk about this 4-step risk management plan, but I'm just going to give you 2 things. So first thing is this, to get you enough so that you guys can start paper trading this and get used to it. And I'm going to give you no adjustments. It could be totally almost automated, so you don't have to sit in front of the screen, and you have a very solid risk management plan. This would be to start with. And you could keep this. Number 1, how do you put this goofy thing on, right? Number 1, it starts with how so number 1 is, let's say SPX, a good, well-diversified vehicle, period. I like SPX as one of the vehicles, very good liquidity, trades a lot of options. So, and let's say you do this trade, and you can do it, put it on Monday or Tuesday. If you got a day off on Tuesday, put it on Tuesday. But the idea is this, how do you put this thing on? So first I'm looking for, I go into Interactive Brokers, and how do I pick my short strike and my short put? And generally, I'm just giving you a guideline to get you going, right? Because this is, I want to get you going on this. I'm going to pick my short put by selling like a 15 delta put. You got it? I'm going to give you in the next minute and a half a good, solid plan for going forward. You with me? How many got what I just said? I'm going to pick my short strike with a 15 delta put. That means it's way out of the money, 15 delta put, probabilities will be in my favor, because if I'm selling a 15 delta put, and let's say the 49.70 put in this example is 15 delta, I think it was a little higher, that means there's only a 15% probability we're going to close through that short strike in 27 days. Number two, my short strike, I'm going to take a 10 delta call. So I'm going to use, I'm just giving you, and there's a lot here, but I'm giving you something to start working with. A 10 delta call. What does a 10 delta call mean? If this strike here, 53.20 was 10 delta, it means there's only a 10% probability we're going to finish beyond that short strike in 27 days. So there's a high probability we'll collect the credit. Everybody with me for the setup? I sell a 10 delta call, 15 delta put. The width of the credit spreads is 10. How many got that? Now, Wayne's, yeah, and I'm just trying to give this, I would say regardless of VIX levels, when you're learning this, yes, do I look at VIX and to get into that in a second, but as you're learning this, I want you to learn the mechanics. We are in a lower volatility environment. I would like higher, but you know, you can do just as well with these in a lower volatility environment. I mean, there's pluses and minuses. A higher VIX, you know, what does a higher VIX tell you? If we're at 18 VIX, you say, well, I'm getting a more room on my iron condor and a bigger credit, but it means the market's getting hammered, right? If VIX is 19, hammered mean it's going down a lot, and that brings other problems. But let's stay with this simple plan here. So any questions on the setup, and then I'll finish with the profit target, and or I'll finish with some of the other information. How many got the setup? 15 delta put, 10 delta call. You're going to enter an iron condor. It's going to be a credit transaction. And right, and then what I'm going to do is I'm going to do a profit target, you with me, of 10%. Am I going to do 10% of a, now, I'm trying to keep this as a good level. Kevin, and you can tell some of the experienced people are saying, why don't you do a 15 delta on each side? I'll just give you that information for the advanced people, but there's two different iron condors. The one I'm mentioning you today would be where I did a higher delta put, 15, lower delta call. That's going to be more, kind of more balanced, closer to delta neutral. If you do same delta iron condor, I would do that more when the volatilities are a little bit higher, because that's going to give you more room on the downside. So there's two types, but staying with this easy example here, profit target, it's 10%, not of the credit, but of the margin. So in this example, if I'm looking for 10%, it's 10% on 770. So for every one iron condor, I'm looking to make about $75, $77. Does everybody get that? Alexandra says, I'm not seeing the screen Dan is talking about. Is everybody seeing the screen? I'm just, in Alexandra, the only thing I'm showing, I'm just on this graph, right? And I'm just talking using a picture. Yeah, that's all I'm doing. So 10% is 75. So if I sold this for 230 credit and I was looking for 10%, let's round it to 75 bucks. If I sold it for 230 credit and I'm looking for 10% profit on this trade, that's 10% of the 770, I'd be looking to make about 75 bucks. So if I sold it for 230 credit and I want to make 75, I'd have my order to buy it back for $1.65. How many did I lose there? Yeah, you're seeing the green line at expiration. That's what you're seeing. So to make a 10% profit, that's 10% on the 770. I'm rounding it to 75 bucks. I sold it for 230. I buy it back for 165. How many say I got it? I got what you just said. I bring in 230 credit. My margin is 770. I want to make 10%. 10% of 770, around 77 bucks. I'm rounding it to 75 for math purposes. 230 credit minus 75. If I sell it for 230, I buy it back for $1.65 debit. I've made 75 bucks divided by 770, or about 10%. And you can, it'll be recorded. Now, let's get to the most interesting thing. To make this a good plan, and I'll just say this because we want to move through this. If I want let me ask you a question. If this, Andrew, take the red ball, the red circle. How many times, folks, have you seen, let's start this journey at 51 1/4 on the green line, Andrew. And let's say today is, you start at 51 1/4, start moving that red ball towards the 49.70. More, 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 stop. So how often do we see it'll start moving down? You're getting nervous. We're getting too close to your short strike. Boom, then it goes the other way, right? So what I'm saying is, you have to, when you're doing a probability trade, and I'm trying to give you some good information, but I'm trying not to get in the weeds and make this totally advanced, right? So what I'm saying is I need to let this breathe a little bit, right? This is a probability trade. So if I'm willing to, if I want to make 10%, I need to make my max loss around 15%, somewhere between 15% and 20%. So if you said, Dan, so you're saying you're willing to make, you want to make 10%, but you're willing to lose 15 or 20%. And I'm saying, as Sylvester Stallone would say, absolutely. Why am I saying that? I need this to breathe. I need the probabilities to work, right? And if I have, because a lot of times it could go near the short strike, boom, bounce back. So this is a trade I'm looking to make win on 8 to 10 times, right? 8 out of 10, I'm looking to win, right? I got to give it room. But the losers, somewhere between that 15 and 20%. You with me on that? So let's just, for example, so we can move on, just to give an example, $770 is my margin. Let's just say times 15%. That's almost $120. So here's what I'm saying, and this is the most important thing in the world of options trading, managing your risk. If that 230 credit goes the other way, goes up to 350, don't look for me. I'm done, right? Because this is, I'm playing this game week after week, year after year. When I'm done, when I hit, let's say 15 to 20%, in this case, 15%, that's 15% of the margin of 770, which would be about 120 bucks. So when that 230 credit hits 350, I'm done, right? Well, what about Fibonacci, or what about resistance, or what about your toe? I don't care, right? To be successful as a range-bound trader, you cannot over time yet let your losers, you can't be losing that much more on a losing trade than your winners. It's simple math. So the encouraging thing is, the most important thing is not that you understand the Greeks or Fibonacci or, physics. No, right? Are you disciplined, right? And when that credit of 230 gets to 350, can I count on you taking it off? Now, how do I get out of it? How do you get out of this thing? I'd have a 10% order in to make my 10%, and I'd put a good till cancel order in. So totally you could automate it, right? If you wanted to. right? Way before AI, you could automate it. You can have an order in that if this gets to 170 or 165, as we said, take it off for a profit, right? And then you could link it, something called a one cancels the other, an OCO order to say, you know, if I don't hit my profit, and this would be a losing one, if that credit goes up to whatever we said, 350, get out, right? And I could talk an hour on getting out more, but does everybody get just a simplicity, or at least that's called risk management, right? Does everybody get the main? Now, if you did this over time, do I think you'd be successful? Yeah. All right. Now, but here's really this thing, right? Here's really the thing. If you said, what's the most important things? Is it how smart I am? No, you know what the most important things are? If you're playing a trade that's got probabilities in your favor, what do you need to do? If you're trading something with probabilities in your favor, should you play every week or should you play once in a while? What do you think? Principle number one. What do you think? You got probabilities in your favor. What the heck aren't you play on a regular basis? And number two, keep your losers in the same stratosphere as your winners, right? You can't be making $80 and losing 300, right? The math won't work. So that's the main thing, right? And I think on a, you know, if you said to me, Dan, how long would I be in a, how long do you look to be in a 30-day trade or a 27-day trade? I look to be in these trades, especially in Iron Condor, it might be 30% of the duration. So if it's a 30-day trade, at the most I'm looking at being around 9 days to get, you know, is a guideline. If it's a 20-day trade, maybe 6 days, right? That's a guideline of what I'm looking to do here. Now, and I would do these, you know, again, you do it every Tuesday, now, maybe I do another webinar on, looking at news events and something like that. I'm just trying to, here's what I'm trying to accomplish today, that many of you will walk away and you can go in an interactive, start paper trading this thing, get it in your bloodstream. So eventually you can do one contract. Now, Andrew, if you could go to the next one. Now we get to the, the part where everybody goes insane. So now we get into the 0-day Iron Condors, and it's a different, to me, I would call these like, how many have ever babysitting a colicky baby? That's what comes into my mind when I'm doing these. They're great. So how did all the 0-day Iron Condors, and first of all, how many of you here have done a 0-day live Iron Condors? As you're putting in yes and no. Never touch them. Now, is it a bad trade? No. So the first, some general principles. Why is there 0-day Iron Condors? Because, when I was trading at the CBOE 20 years or whatever ago, they didn't have options that expired every day, right? You'd have expiration once a month. So we're in the Wild West, but I think it's good. It brings 0-day options bring a lot of people into the options industry. It's just that what you need to do when these people come in the industry, you got to teach them risk management, or in 3 months they won't be around. So I'm thankful they come in, but what new people learn, you need risk management, right? What else? You need risk management. And what's one more thing you need? You need risk management. That's the only thing that's going to keep an option trader, especially in the range-bound world or speculative, around for 10 years. You have to understand risk management. So here, so a 0-day Iron Condor logistically is the same as a 30-day Iron Condor. You're selling an out of the money call, out of the money put, your wings are 10 points away. So in this example, I'm bringing in a credit of $1.20 I took this example on a morning on March 1st, and the margin is 880. So is it the same graph that we looked at a 30-day? Yes, but it all happens at one day, right? So, and generally I would do similar, sell it, how would I structure? So let me just run you through the world of a 0-day, right? You ready? Let me run you through the world of a 0-day, a plan, right? Very similar. Is the 0-day, bring us up a good question. Is the 0-day day trading? Yes or no? Is the 0-day, is it day trading? Well, here's the thing, and maybe Andrew can, before I give you a plan and give you my 10 cents on 0-day iron condors, and we'll start going at a closer clip here. I think they have it. If you're getting in and out of what is it at Interactive Brokers, Andrew? Is it if you have an account, if you're on 3 trades in a week or whatever it is, if you get in and out of a trade, you get in a trade today and you get out of it today, if you have an account, I think, wouldn't it be like if you have an account under 25,000, they limit those types of trades? Is that correct?
Yeah, they count them, and if you do a certain amount, then you're considered a pattern day trader.
Yeah, if you have an account that's 25,000 or more, then you can do more, correct?
Yep.
All right, so here's my thoughts on 0-day. Ready? I'm going to give you all this in about 3-4 minutes, how I would trade them and my thoughts on them with an iron condor. So I like 0 days because there's no gap risk. You're not taking this sucker home overnight, right? And you put it on a day, and most days, can you, on a 0 day, if you're, if the market, gaps, gaps, the nice thing about 0 day, A, you don't have a gap. You don't have any gap overnight. B, you can choose. You have choice, right? If there's going to be a Fed announcement during the day, once every quarter when Powell comes and speaks, or some news during the day, or maybe the market gapped open 50 points, choice, do you have to play that day? No. So, and as you play, so that's nice choice. I mean, I would say, just a couple things on the top of my mind, when there's good, what I found experience-wise playing these, if you have a lot of news coming out on Thursday or Friday in a particular week, how often do you see that Monday, Tuesday, Wednesday that are pretty quiet leading into the 2 news days? Yes or no? That happens a lot, right? If you have 2 or 3 days before, Thursday's going to be a jobs number, or Friday, 3 days before. But overall, the idea here is you do have choice. I'm looking to play on a regular basis, right? A lot of people will say, I play the last hour of the day, or some people will say, I put it on at noon, or some people would say, I put it on in the morning. You know what my answer to that would be? Be consistent, right? Because part of this has to work around you, right? I mean, there's, depends on your schedule, right? I would say just, hey, pick a time, maybe let the market open for an hour, and pick a time between 9:30 Central and maybe 12:30 Central in that window, and get used to doing it at that time. The more you do these, you'll get better, and you'll make natural tweaks. Does that make sense? Yes or no? Yes or no? 9:30 and 12:30 Central. That gives the market a chance to develop a little bit of range, be open for an hour, then you can jump in, right? Now, for advanced traders, they might do something like, for advanced traders, hey, you can say, well, the market can move around. So I like at least an hour before the once the market's open, to let that high-low range, let it develop a little bit. You can kind of see what's going on. Now, for some advanced traders may say, okay, I'm going to put one iron condor on at 9:30. I'll put one on at 11:30 and one at 12:30. Anybody ever do that? That would be, use the word scaling. That would be more advanced. Anybody ever do that? But I won't talk about that today. So, but same principle, right? So we can go a couple different ideas here, right? So here's what I'm going to do. You ready? So here's a game plan, but here's the thing. Can you stick with it, right? So number one, in this example, we're bringing in $1.20 credit. Margin is 820. And part of what you can do, I'll give you a couple ideas, right? I'll give you two ideas. I'll give you one idea. Just I'm trying the simplest I would do it. Idea number one. You ready? You have the $1.20 credit. I'm either gonna make the whole thing. You with me? So no order to take it off for a profit. I'm gonna let it expire worthless, right? That's one way to do it. You with me? So that's zero touch. Can anything be easier than leaving it alone? Yes or no? Can anything be easier than doing nothing? Yes or no? Do nothing, right? Now, here's where the risk management comes in. If, right, if the iron condor, you see it's at $1.20 credit. If, right, you with me? So here's your only risk management. If your margin, right, if I'm down, as we said, we're given a range, 15 to 20%. Let's take 15%. 15% of 820 is about 120 bucks. Everybody with me? The margin is 820. 15% of that is 120. So what am I saying? When my credit that I sold for 120, if it gets to 240, get out. How many could do that? I'm giving you one thing to do, and you can even put an automated order in. And in many cases, I'd rather an automated order be in than you messing with it. Excuse me, I love all of you. But if you gave me a choice, would I rather have an automated order or you there? There's no question. You with me? Don't you agree? An automated order will do what you want it to do. Agree? If I tell Hunt, when I'm down this amount, get me out, could Hunt say no? Could Hunt say, Dan, it's a Fibonacci point, I'm gonna wait? Could Hunt say, you know what, I was out talking to the neighbor, I'm not here? Could Hunt say, I fell asleep on my couch watching a soap opera, right? Automated order, it'll kick in, right? And what I'm saying is that 120 credit, when it hits 240, what am I gonna do? Am I gonna take the whole thing off? No. If we're going down, I'll take the put side off. If we're going up, I'll take the call side off. That's it, right? So I have an order in. Now, you'd have to see the types of, get used to the types of orders you have at Interactive Brokers. But depending, now, when it hits ideally what I'd like to happen is when the 120 gets to 240, right? You go back in and buy the bad side back. How many think they could do that? How many think they could do that? Commissions are pretty cheap these days. Compare, you know, I mean, the commissions won't be but I'm saying, how many think they can do that? Is there a plan? Now, you say, that's risk management. Risk management is keeping your losers under control. So there's no commissions getting, I'm either going to get the whole credit, right? Or I'm just going to take one side off, right? If we go down, it's the put side, upside the call. But you know what? I'm going to challenge you with something, and then I'm going to, the next 10 minutes, bring this to a close. But there was a movie with Tom Hanks, Can You Handle the Truth? I would bet Andrew 14 pizzas, right? That even if I made a challenge to all of you, right? I'll make a challenge, right? I'll make a challenge just to show you what I'm thinking. If there's 100 people in here, whatever it is, I'd make a challenge. I'll send you, right? If you say, Dan, I'm going to do this for 10 days straight, a 0 day, or I'm going to do the other one, 10 trades, whatever. And it could be paper. It could be live if you know what you're doing. Small, but do it paper and send it to me. I trust you. I'll put it on a spreadsheet. I'll put it and do it 10 days in a row. I've issued this challenge over the years for whatever reason. I hate to say it, but 90% of you wouldn't do it. You say, Dan, come on, it's just 10 days. Okay? You see where I'm getting from, right? Life gets busy, right? But that's the biggest thing, is doing it. And here's the other thing. If you do a trade 10 times in a row, are you going to get better at it? Yeah. You know who the best 0 day traders in our community are? The ones who did it the most. Isn't that shocking, right? The best people in our community on credit spreads, they've done the most, right? It's a craft, right? Now, as Roger says, are we looking at, is the market chop? You know, but I think first stage is, the most important is putting it on. I mean, how many days have you looked at, Roger, and said, hey, the market's, oh, this is too volatile for a 0 day. Oh, the news is too crazy for a 0 day. And they work fine, right? It's the risk management. Control the things you can control. Now, before I go to this, there's a slide or two and give you the general, you know, the guidelines and everything. Let me take maybe a minute or two of questions on some of the specifics, right? On this thing, right? But I'm selling, I think on the 0 day, you could sell a 10, the way I picked the short strikes, you could sell a 10 delta call, 10 delta put. You could sell a 10 delta call, 15 delta put. I'm trying to get my position deltas at the start close to neutral. In other words, what I'm trying to do is, like Andrew will show here. Andrew, if you take the red ball, when I'm doing a 0 day, it's a little bit different than a 30-day traditional. I want a little bit of balance. You know, like, so if you look at the middle here, 51.26 is the middle. It's kind of equidistant to a degree, right? The short put and the short call are, you know, the short put in this instance is 21 points below the 51.26. The short call, 51.55, is 20.46, 29 points. Okay, so it's a little bit different. Not that that's the end of the world, right? But you can see the deltas on the far left, I'm short a little bit. So generally, I'd like the deltas to get 0, close to 0 starting out. But here's the thing, a lot of what Roger and others are bringing up, once you do 10 or 20 of these, you're going to get much better at it, right? And so you'll be able to see some of the differences. I'm just trying to get you going to do it. Now, Andrew, could you go to the first, unless there's a slide after this, the beginning slides where I can give the guidelines. So was there a slide before this one? So iron condors, what is this trade? And this would be, you can watch this in review. You're selling an out of the money call and an out of the money put called a short strangle. And then you're buying your hedges 10 points further out of the money on the call side, 10 points further out of the money on the put side. Why do iron condors? It's a high probability trade. It gives you positive theta. You can use it for daily potential income, weekly or monthly. It's a good range bound trade. What vehicles to trade? I like SPY for smaller traders, and I do mostly SPX. You can trade RUT. I like indexes or ETFs that are well diversified versus, you know, does it mean you can't do a can you do an iron condor in a liquid vehicle like Tesla, Apple? Liquid means you trade a lot. Microsoft, yeah, but it's just, I'm spoiled because SPX, I don't have to worry about, if I do an iron condor in Tesla, yes, the volatilities are higher, I get more credit, but what if Elon does a crazy, do you want to deal with that stock risk, right? Where, Elon says something crazy. And so I don't look just, okay, I want to do an iron condor and where I can get the most premium, the highest credit. No, because that's, there's two sides of that coin, right? If I go to where I can get the most premium, the highest volatility, those are going to be in stocks that have a much higher potential of moving a ton and hurting you than the SPX. So don't always think that high volatility means it's better, right? You're getting high volatility. Like if you get, Dan, I would rather do 13. How many would say, right? I got a question for everybody. I got a question. Would you rather do an iron condor in a 13 volatility, which we are now in VIX, or in a 20 volatility? And a beginner might say, what's the difference? If the volatility is 20 in SPX, you're going to get a little bit better credit, but you'll get a lot more room. So how would you answer me? Would you rather do it at a 13 or 20? Most of you would say, I'd rather do it at a higher volatility, right? Here's my answer. If the VIX pops up to 20, that means SPX is getting the daylight speed out of it and it's going down fast. So I like high volatility, but I would rather, if the VIX goes to 20, I would rather sell it at 18 when things stabilize. Because if the volatility starts skyrocketing, the market's going down. I want to make sure things have stabilized. We're getting some two-way. So it's like in the COVID correction, volatilities went to 80. Were we selling volatilities at 80 or 70? No, we was waiting till the markets, started coming back and we're getting two-way. So instead of selling at 80, I'd rather sell it at 60 and get some two-way action. Anyways, is this trade for potential monthly income? Yes. What is the risk of the trade? The risk of the trade is the difference between your call or put credit spread. If it's 10 wide, you have $1,000 of risk less your credit. What's the potential profit of this trade? The credit. Andrew, can you go to the next one? So 4-step risk management plan. Today, I only focused on setup and profit target and max loss. I said setup. Let's sell a 10 delta call for a 0 day and sell a 10 delta put. Buy my wings. If I'm a beginner on a 0 day, 5 points away, a little more experience, 10 or 20 points away. That's setup. Which strike do I sell? Which strike do I buy? What's my duration? Profit target and max loss. I'm looking to make 10% of my risk or margin. I don't want to lose more than 15 to 20% of my risk or margin. I didn't get into today step 3 and 4, when to adjust and how to adjust. On 0 day trades, if you get more experience and you want to do an adjustment, one adjustment a day, yes, but I'd say overall, when I'm 0 day, I don't like to do adjustments. If I'm doing a 30 day or 40 day, I might do some adjustments, but again, just because you do adjustments doesn't mean it's going to be better if you do what I talked about today, right? If you do what I talked about today, that's risk management. Okay, I'm going to make 10%. I'm not going to lose more than 15 or 20. That's risk management, right? It doesn't mean just because you adjust it that you're going to do better at it. But that would be maybe another seminar on adjustments of some of this iron condors and stuff. But hopefully this got you going to, when you see what's important with these trades, it's put it on, keep it going day in, if it's a 0 day every day, if it's a traditional 30 day iron condor, once a week. But I want to encourage you to practice this a little bit, because this, folks, the most important thing is not how much you understand. I mean, the most important thing after, your success on this is going to come down to the 2 or 3 times where the market goes crazy and you kept your losses right where you wanted them to. That's discipline, right? So anyways, I have a couple comments. Yes, maybe I could get into maybe another one, do risk management and adjustments. But anyways, I appreciate everybody taking time. Again, don't think, I want you to understand something. Don't think that just talking about adjustments is like the panacea for all of this. No, what I talked about today, right, is very strong risk management, right? But it's saying, as Barney Fife would say, nip it in the bud, close it when you're supposed to. Adjustments, I think your first 10, 20 iron condors, don't do adjustments. Just get used to the structure. And then as you get more comfortable, you can learn about adjustments and that type of thing. Bradford says, do you have a rule of thumb how many contracts to trade at one time? Good question. Here's what I would do. If you say, Dan, what's the size? If you don't have experience, do paper trade for a while, couple months, make sure you understand what you're doing. Then I would go 1 contract in the SPX, 1 contract doing 5 wide strikes. You can do a 0-day where your credit spreads are 5 wide. You can do it for probably $300 of $300 to $400 of maximum risk. If you do a traditional iron condor 30 days out, I would do 10 wide differences in the credit spread. So what I'm saying is I would do 1 contract start out, do that for a couple months. If you're making 1 contract, if you're making money on 1 contract and you're not doing 3 stooges, then work your way up. Okay, I understand a bit. I'll go to 4 contracts or 5. It's that foundation, right? I've had students that their first year they were trading a smaller amount, but once you learn the business, once you learn the craft, then it's easier to build the size. It's the foundation that's important. So I would stick with, if you're more experienced, you could do more contracts, but I'm a big proponent of start small, work your way up as you get better at it. So folks, have a wonderful day. Appreciate you taking time with us today. And if you have any questions, you could email Andrew or you could email me. Would be happy to help you in any way I can. So thanks, everybody. I appreciate it. And Andrew, always good to meet with you.
One correction, Dan. It was Tom Cruise, not Tom Hanks.
Oh, did I say? Oh, yeah, I said Tom. That's right. Tom Cruise is, yeah, you can't. But it was Jack Nicholson who made that statement, wasn't it?
Few Good Men?
Yeah, didn't you? Or I'm thinking the movie where he says, you can't handle the truth. I think that was Jack Nicholson, but yeah, I don't.
You're right. I think it was A Few Good Men, wasn't it?
Yeah. I forget my movies.
Tom Hanks was in Big.
Oh, yeah, that's right. Yeah. Tom Hanks seems like he's been in every movie. But, well, thanks, everybody. Appreciate it. Thanks, Andrew. And we'll see everybody later.
Brilliant. Thank you very much, Dan. And folks, Dan at SheridanMentoring.com, or you can contact me at webinars@Interactive Brokers. Thank you very much for your time today, everyone. Bye, Dan.
Thanks.